Good afternoon and welcome to our Genscape Refined Products webinar on the gasoline and distillate supply chains, a case study review of the Colonial Pipeline outages and what's ahead for diesel demand. Our presenters today, I'm Suzanne Danforth. I'm the Director of Products and Price Assessments Development here at Genscape. We'll also be hearing from Jeffrey Kerr, who's the Senior Product Manager for Oil. He'll be talking about a bit of our Waterborne data. And Dylan White, who is our oil storage analyst focused on New York Harbor refined product storage. You can ask us a question at any time during this webinar. There's a text box on your screen. Just submit your question, and it'll go into our inbox. And we'll be doing Q&A once we're done with the presentation. And just to note, today's presentation audio is via computer only. There's no dial-in number. We will have the slides and the recording ready for you tomorrow morning. It'll be sent out to all registrants. With that, I'm going to do a quick overview of Genscape, who we are, and what we do. Our mission is to ensure greater transparency in the commodities and energy markets by providing accurate and complete fundamental data. You see the graph on the right here. It's simple microeconomics graph, the intersection of supply and demand at price. And our goal is to provide accurate and complete fundamental data to help complete those supply and demand curves. Genscape data brings efficiency to markets by shedding light on key market fundamentals in commodities markets like production, storage, transportation, and consumption. And Genscape is the industry leader in real-time collection, analysis, and distribution of fundamental production data in the commodities and energy markets. What differentiates Genscape from other fundamental data providers is our ability to capture data in real time, providing the most current, up-to-the-minute, market-moving information. And it's the real-time nature of our data that allows for better trade execution and supply optimization, as fundamentals that were previously opaque or were delayed are now transparent and readily available. We provide this real-time fundamental data across commodity sectors such as power, oil, NGLs and petchems, gas, agriculture and biofuels, and maritime shipping. And around our physical data, we also provide context and insight with value-added explanations and recommendations. And as I said, this can help drive trade decisions, production decisions, or supply optimization decisions. So how do we collect our real-time fundamental data in oil? So we use a number of different methods. We use thermal and visual imagery to measure individual storage tanks and produce weekly storage figures on the crude oil and refined product side. For crude oil pipelines, we monitor power consumption at pump stations, and from that we're able to derive pipeline flow models that estimate the pipeline flow as frequent as every half hour for pipelines. We also use thermal imagery to monitor refineries, refinery units like crude units, cokers, FCC units, fluid catalytic crackers, alkylation units, etc. And with this monitoring, we receive images every 5 minutes. We're able to detect when a unit goes down, when there's an upset or a fire, when a unit comes back up, or we see flaring indicating an upset at a refinery. Genscape also owns a company called Vessel Tracker, which operates the largest AIS antenna network for ships in the world. And through that AIS antenna network, we're able to monitor vessel movements for both crude oil and refined products. So we aim to cover the entire supply chain in terms of fundamentals, production, storage, pipelines, refineries, and adding on top of that a layer of market intelligence. And we've accomplished this for North American crude oil across the entire supply chain. And now we are working towards looking to cover the entire supply chain in terms of fundamentals for refined products. Here are just a few stats on our monitoring across the various supply chains, showing you how much crude oil storage we monitor, pipelines. We also monitor crude by rail, both loadings in the Bakken and in Canada, as well as offloadings in the Mid-Continent and the East Coast. We cover about 80% of U.S. refining capacity with our monitoring. That's about more than 500 units. In terms of product tanks, we monitor 68 million barrels weekly. That's in the PAD 1B area, the Mid-Atlantic. And we also monitor NGL processing units and NGL pipeline units. So next, I'm going to go through looking at the 2 recent Colonial Pipeline outages and the impact we saw in our various fundamental data sets. Now, the primary data we've used to analyze the immediate impacts of those 2 Colonial outages is from our supply-side monitor and analyst products. Genscape supply-side data for gasoline and distillates is based on actual transactions at the rack. So when a truck pulls up to a rack and loads a set volume of gasoline or diesel, we capture the volume of that transaction and the price, and then we aggregate those transactions by rack city, by state, and by pad level. This is the industry's only product that provides actual rack activity, which can be used to measure real-time refined products consumption. So because of that, this rack activity data has an unparalleled view into how supply disruptions and weather events can impact local and regional refined products demand. And the 2 recent Colonial Pipeline outages demonstrate this. So first, a little bit of background on Colonial Pipeline. As you know, it's the largest refined products corridor in North America. It's critical to supplying the Southeast as well as the Northeast with gasoline and diesel from the Gulf Coast Gulf Coast Refining Center. The Southeast is mainly inland, doesn't really have access to waterborne refined products, and refining capacity is limited. So Colonial is very important to local and regional markets in the Southeast along lines 1 and lines 2. From Greensboro, North Carolina north, that's where lines 3 and 4 are, which are a smaller capacity than lines 1 and line 2. And they head up through the Northeast. The Northeast does have waterborne access in ports like Baltimore and in New York City, but it still relies on Colonial as a key supply conduit. There's also the 700,000 barrel a day Kinder Morgan Plantation line, which is a refined products line that runs parallel along this corridor. But not all rack cities have plantation access. Some have access to both Colonial and Plantation, but especially in the Southeast, there are rack cities that solely rely on Colonial for their refined products supply. So just a review of the 2 shutdowns we saw with Colonial Line 1, that 1.3 million barrel a day gasoline line in September and October. So on September 9th, there was a spill near Shelby County, Alabama that prompted Colonial to shut Line 1. During that time, a bypass line was built around the spill. It took approximately 12 days for this to be completed, so the line was down for 12 days until September 21st. During the outage, a few days after the spill took place, the shutdown took place, Colonial allowed customers to ship gasoline on line 2, which is typically a distillate line. And less than 2 months later, there was an explosion at that same site where the spill took place, and that immediately forced Colonial to shut lines 1 and line 2. Line 2 was restarted just later that day on October 31st, and for this outage, Colonial was only down for 6 days. And during this outage as well, immediately when line 1 was shut down, Colonial allowed customers to, again, ship gasoline on that distillate line, line 2. So looking first at the September Colonial outage, this is a state-level view using our Genscape supply-side data for total motor gasoline. That includes regular, mid-grade, and premium. And these are the 4 states that are serviced by Colonial Pipeline's Line 1 for gasoline: Georgia, North Carolina, South Carolina, and Tennessee. And as you can see, that September outage had a significant impact on rack activity, and the impact really came not immediately after the outage, but about 7 to 10 days later as the outage persisted. The hardest hit state, as you can see from the graph, was Tennessee. Volumes across the entire state of Tennessee fell as much as 24% below week-ago levels during the outage, or around that September 17th timeframe. Most rack cities in Tennessee depend on Colonial primarily. Nashville, for example, one of the largest rack cities in Tennessee, is Colonial supplied only. Only a handful of rack cities in Tennessee have access to the Plantation line. So this shows a selection of some of the larger rack cities in the southeast that felt the brunt of that September Line 1 outage. As you can see, Nashville was one of the hardest hit rack cities. We saw week-on-week declines around September 10th as much as 69%. Chattanooga, also in Tennessee, gasoline rack activity there was more than 50% below the previous week around that September 17th timeframe. In South Carolina, North Augusta, the largest rack there, we saw total gasoline rack activity decline 70% below the previous week from September 17th to September 19th. And in Atlanta, which is the largest rack city in the southeastern U.S., total gasoline rack activity declined as much as 28% from the previous week on September 17th. So overall, as you can see from the graph, the longer that Line 1 outage persisted, the more pronounced the impact was on gasoline in the southeastern rack cities that were supplied by Colonial. Eventually, the line came up September 21st, but you can see some recovery before that time due to the movement of gasoline on Line 1. And we began to see, with some of our other rack activity for Savannah and Charleston, folks beginning to load gasoline from those two waterborne ports to then truck inland to those rack cities that were impacted by the Colonial outage. But it took some time during the September outage for that to happen. So this is a snapshot directly from our dashboard for the supply side product that shows where we were during the worst of the September Line 1 shutdown. Some of the rack cities that had close proximity to waterborne ports like Savannah and Charleston, like Macon, Georgia, for example, seem to fare better than others. And also those rack cities that have access to plantation like Knoxville, Tennessee, or Columbus, Georgia, they seem to weather the storm a bit better than those cities that fully relied on the Colonial Pipeline for their gasoline supplies. Taking a look at price and how price was impacted by the Line 1 shutdown, this is a graph that shows the highest rack city prices per day for regular gasoline. So in our gasoline, in our gasoline data for Genscape supply side, we offer a daily total of volumes, and we also offer per day the average rack price, the high rack price, and the low rack price per transaction. And this graph shows that high rack price per transaction. As you can see, it was around that September 15th, 16th, 17th time frame when we really saw the volumes being impacted by the shutdown of Line 1, that prices reacted at the same time. In most rack cities, some of the higher prices that were done were brushing up against that $2 a gallon level. The highest rack prices we saw during this time period were in Chattanooga, Tennessee at $2.10 per gallon, and in Greensboro, North Carolina at $2.10 per gallon. So when Colonial Line 1 shut down on September 9th, there were a lot of theories out there this would be devastating for the Northeast because the Northeast is that end destination for the Colonial system, and we would see some huge impacts to the densely populated New York City area. But looking at our supply side data, the impact on the northeastern rack cities was really minimal compared to how impactful this outage was on the southeast. And that was due to a number of factors. The Northeast has access to the water. So as Jeff's going to go through later on this presentation, you had imports coming in of gasoline that could help mitigate the loss in supply of gasoline coming off Colonial. And also there's a lag in the transit times on Colonial between when barrels would be hitting the southeast and when barrels would be hitting the northeast. And that gave rack suppliers some time to optimize supplies, to move supplies from other areas, to make up for that expected shortfall in Colonial gasoline. So Baltimore and Paulsboro, New Jersey were the most affected by the September Colonial outage, and this seemed to come several days after the restart of the line on September 21st, and that's due to the lag in that transit time, like I mentioned previously. In Paulsboro, New Jersey, we saw total gasoline rack activity fall by as much as 40% on September 25th compared to the previous week. And in Baltimore, gasoline rack volumes were as much as 27% below the previous week on September 28th. Now looking at the October outage, volumes were impacted by that October 31st shutdown across the Southeast. These are the same states we saw in the September look. But the impact was minimized relative to what happened in September. This graph shows volumes through the restart of the line on November 6th. And as you can see, it took a few days for the impact of the shutdown to really hit gasoline rack activity across Georgia, North Carolina, Tennessee, and South Carolina. And prices didn't really react much during this outage. And, I think the two factors here were that this was a much shorter outage than the previous one. And also, we had been here before. We just went through this in September, and the industry learned a lot of lessons about really how to optimize supply with this kind of shutdown going on. So the impacts we saw to volumes in our data and the impacts we saw to prices in our data weren't nearly as extreme as what we saw during September. These are regular gasoline rack prices, and they generally declined for the most part during that October 31st to November 6th outage. There were some localized price spikes in Albany, Georgia, and Charleston, South Carolina, but in general it trended downward, and this also aligns with the muted impact we saw in the gasoline rack volumes relative to how dramatic things were in the month of September during that shutdown. And this last slide is showing what happened with rack activity in these key waterborne ports of Savannah, Georgia, and Charleston, South Carolina. So during the September shutdown, we saw suppliers beginning to load way more gasoline than normal at Charleston and Savannah with waterborne supplies coming into those ports, and then moving that gasoline inland to make up for the shortfall and what was not coming off Colonial. But this move didn't really pick up momentum in September until about a week after the line shut down. So given the operational experience from that previous outage, the industry reacted far more quickly following the October 31st Line 1 shutdown and began to load gasoline supplies from Savannah and Charleston to then truck inland at a very rapid pace. Savannah loadings on November 6th were 425% above levels seen the previous week. And what this did is it seemed to mitigate the supply disruption in nearby rack cities and prevented the rack activity for gasoline dropping to low levels by providing the necessary supplies needed to maintain operational rack activity for gasoline. And with that, I'm going to turn it over to Dylan, who's going to talk a bit about New York Harbor refined product storage.
Okay, thanks, Suzanne. So like she said, next we're going to be talking about the impact of these Colonial outages on refined product storage, looking particularly in the Northeast at the New York Harbor hub. So first, to give you a quick overview of Genscape storage monitoring. You can see the individual breakdowns there, but total we monitor about 700 million barrels of storage capacity every week, and that's about 4,300 tanks. So looking specifically in New York Harbor, we monitor gasoline, heating oil and diesel, jet fuel, and ethanol. So New York Harbor is particularly important because these terminals serve as a delivery point for the NYMEX, RBOB, and ULSD contracts. So total these terminals are going to add up to about 65 million barrels of storage capacity, and that's about 660 tanks. So of that capacity, about half of it is going to be gasoline. So Suzanne was talking a lot about the impact of the outages on truck rack loadings in the Southeast. So this is the same data, but looking at the Northeast, so specifically PAD 1B, which is a 5-state region, including New York and Pennsylvania. So up here, we really didn't have the same impact on the truck rack loadings that we did in the Southeast. So Suzanne mentioned that one of the main reasons for this is that the Southeast is more dependent on Colonial Pipeline as a source of gasoline. New York Harbor and the Northeast in general, they can source from from Buckeye Pipeline and East Coast refineries and waterborne shipments. Another reason is that there's a lot more storage capacity in the Northeast. So looking specifically at New York Harbor, again, it's a giant storage hub. It's the biggest refined products hub in the nation after Gulf Coast. So in situations where there's a supply disruption like this, they can pull barrels from storage to help cover the losses in the meantime. So that's exactly what we saw happen. This chart is New York Harbor gasoline stocks as monitored by Genscape. So that green line is stocks in 2016, and you can see roughly where the outages were, where they occurred on that timeline. So after both of these outages, we did see decreases in gasoline inventories in New York Harbor. So after the September 9th leak, stocks decreased over the next 3 weeks about 2 million barrels. By comparison, in October, after the explosion, in the next 2 weeks, stocks decreased about 700,000 barrels. So not nearly as much, but it was a shorter outage, so we wouldn't expect as much of an impact there. So looking back at the September outage, you might notice that stocks though started decreasing actually before the outage occurred, and that's completely right. Between August 19th and September 30th, stocks decreased about 4 million barrels. So obviously these declines started before the outage occurred, so the Colonial going down cannot be solely attributed for these draws. So September is kind of an interesting month for New York Harbor refined product storage anyways. There are some other factors at play that contributed to those draws. So one big factor is refinery maintenance. So fall is a popular time for refiners to shut down gasoline producing units and do planned maintenance on them. It's a good time because they're coming out of summer when gasoline is in high demand, and at that time they want to kind of run full speed ahead and pump out as much gasoline as possible to make sure they're covering that demand. Once that eases off in the fall, they can shut down some units, which you can see in the green line here is units that produce light products or gasoline. So if you look on the left side of the graph, you can see around this time last year, we're kind of easing our way out of this turnaround season. And we saw that same thing happen this year. So beginning in late September, quite a few refinery units on the East Coast were shut down, and utilization overall on the East Coast dropped from pretty close to 100% down to roughly 70% before rebounding in October. So there were quite a few projects going on during that time that led to that decreased utilization. One of the big ones is at Irving St. John, and they had a huge refinery maintenance turnaround project, and it actually had an awesome name. The name of that was Operation Red Fox, which is a great name. So if there's anyone listening from Irving, good job. Some other refinery maintenance projects going on at that time were at Monroe Trainer and PBF Paulsboro, where they had FCC units shut down at both. So as these units go down, the refiners are producing less gasoline, and there's less supply going into the Northeast and New York Harbor in particular. So this is compounding with the decreased supply from Colonial and leading to that decrease in stocks that we're seeing. Okay, so another factor at play here is this seasonal regulation shift from summer-grade gasoline to winter-grade gasoline, and that switch is going to happen on September 15th. So this regulation is put in place by the EPA in the 90s, and it's to help monitor and moderate emissions from gasoline during the summer months. So they monitor this via RVP, or read vapor pressure, which is a measure of volatility. To get down to this spec, summer-grade gasoline is going to be more expensive to produce in terms of refining and blending. So because summer-grade is more expensive, storage owners are not going to want to sell it after that regulation shift on September 15th because they would be selling it at winter-grade costs. So because of this shift, we see some interesting movements in the gasoline stocks in New York Harbor right in mid-September there. So in the last 2 years, in 2014 and 2015, we've seen buildups in the week or two preceding that regulation shift, and this is likely storage owners building up winter-grade gasoline so they're ready for that regulation shift. And then on that week of September 15th, we see unloading of inventories, again, just unloading that winter grade and sending it to retail locations. So what's interesting is this year in 2016, we did see the drop down in inventories that week of September 15th, or the week after, I believe, and that happened to coincide with the Colonial outage. What we didn't see was the buildup preceding the regulation shift. So what's likely happening here is the same thing was happening as in the past, with storage owners building up winter grade in preparation for the shift. But that is likely offset by decreased supply from Colonial. So the inventory changes ended up kind of being a wash. You can tell that the stocks were relatively flat there for a couple of weeks. So if anything, this supply disruption kind of helped mitigate the seasonal transition that we see every year. Okay, so what does all this mean? If you zoom out and take in all these factors, then really the draws that we're looking at through late August and September were not really as substantial as they could have been, all things considered. So yes, obviously 4 million barrels across a month and a half. That's pretty considerable, but when you take into account that a major pipeline went down, several refinery units that produce gasoline were down, and this is a month when we sometimes see stock decreases anyways, the impact on inventories, it wasn't detrimental or show-stopping. We never saw tank bottoms. Inventories never reached dangerously low levels. Most importantly, the consumer was relatively unaffected in the Northeast. There were no gasoline shortages at gas stations like there were in the Southeast. They might have seen some price volatility, but that's about it. So with the Colonial outage, there's a lot of news and attention in the public eye when information on this was being released. So everyone's trying to synthesize data and figure out what exactly is going on. So taking this Genscape data and combining the storage data with the supply side data, with the waterborne information that Jeff's going to talk about, you can get a pretty clear picture of the real-world impacts on the supply chain and see what the effects actually are to the market. One more note before I hand it off to Jeff. If you look at the inventory draws that we're talking about, they're coming from near record high levels. So speaking of things that are getting a lot of attention in the news, there's a lot of talk about the refined products glut and the oil oversupply as a whole. So that's something that we've been seeing pretty much across the board in our storage products, and New York Harbor has not been exempt from that. So in February, gasoline stocks reached the highest level we've seen since we started monitoring in November 2013. Since then, they came off that high a little bit, but rebounded and stayed pretty high through the summer. And the summer is typically a time when inventories for gasoline draw down based on high demand. It's peak driving season. So stocks usually go down and come back up in the winter. This year, stocks stayed pretty level and consistently high through the summer, which is pretty unseasonal. So obviously, needless to say, pipeline leaks and explosions are bad news. It's no good, obviously. But kind of the silver lining of this tough situation is that the supply disruption did help alleviate this glut that has been pretty persistent in New York Harbor. Okay, so on that note, I'm going to pass it along to Jeff.
All right. Hi, I'm Jeff Kerr, and I'm going to now talk about the waterborne side of things. So in this slide here, we have PADD 1 gasoline imports. And these are all the imports coming in basically on the water. And you can see on the left side of the chart, as we're looking back to the good old days back in 2006, 2007, back when the economy was screaming, everything was going great. Gasoline imports are running very, very, very high. Things were pretty good in the U.S., especially PADD 1. And then we had right around 2008, 2009, the economy pretty much goes to hell, and gasoline imports start to fall, and we go through a period of demand destruction. And so we start seeing this gradual decline that really seems to arrest right around the time of January of 2014, and then we kind of get into a stalling pattern, maybe starting to see a little bit of increase right around 2016. So we're really pretty much off the highs, and this kind of puts everything in perspective. You can see that the gasoline imports, and this is from the EIA, haven't really gone above 800,000 barrels a day since January of 2011. So it's been a while, and now let's see how this translates into the data that we put together at Genscape. This data comes via our European Waterborne Products Report, put together through our use of Vessel Tracker and other technologies, where we are looking at all the ships that are moving transatlantically refined products. And we go through a whole process of determining what's on the ships and where they're going, verifying on both sides of the Atlantic, you know, which terminal that it came from, which terminal it's going to, and coming up with our ideas on basically, you know, what the gasoline picture is going to look like. And so going back to September of 2015, all the way forward to October of 2016, and I actually saw some new data for the first half of November this year, you can see that a comparison of the September 2015, October 2015 to September 2016, October 2016, this year we're a lot higher than last year, and I think this is a direct reaction to the Colonial outages. Most of the gasoline that gets imported from Europe comes into the New York Harbor area, and as Dylan ably pointed out just a little while ago, that gasoline comes in because we have the most storage in the New York area. It's also, we bring in the most blend components. There's massive blending operations, probably more blending operations than actually refining capacity. So people are able to then distribute from this area, and most of that distribution is through pipelines and also on waterborne through tankers and articulated tug barges. The distribution points go up into Pad 1A, which is New England, Pad 1B, the Mid-Atlantic states, and then Pad 1C, which is the Southeast, including Florida, which of course has very little pipeline capacity and has a tremendous amount of people down there, so they need to have waterborne delivered refined products. The other ports that are listed on here, you know, Boston, Providence, New Haven, Philadelphia, Jacksonville, Charleston, Savannah, and Wilmington also take direct imports from Europe, but it's not really on the kind of standard basis that you'll get in New York. Boston pretty much does, but not at the same kind of volumes. And then you'll see the other ports, namely Philadelphia and Providence, will also get some, but even Charleston and Savannah, which were so important during this colonial outages, didn't get the kind of steady volume of the European imports that you would have expected. So it's really New York Harbor, and we'll see in later slides the Gulf Coast that helped solve the problem. And so, you know, drawing out the data into a line chart here, you can see how the New York Harbor gasoline imports really kind of reacted. And, you know, of course, the summer is where we get most of the imports. That's mostly the driving season here in the States. But we do have this somewhat atypical September-October increase. And from what I've seen of the November data so far, the November data is a little bit higher than the October valley there. And looks like it will probably increase maybe up to the September level as well. So Europe has stepped up, seeing an opportunity with the little outage bubble that's moving its way up the Colonial Pipeline. So that's one of the things that we see from coming from the data. And so as I examined the shipping routes to determine, okay, did any ships change direction as they were as the outages unfolded? These are the ships that I happened to see move out of their normal patterns. The Ohio was kind of a celebrated case. It was the first written about that was moving out of its normal pattern. The Ohio, the ship that was mostly moving from the Gulf Coast into the Tampa or Port Everglades, Fort Lauderdale area, moving gasoline back and forth. This ship was written about that it was going to be moving up to the New York Harbor as the first of the ships to kind of help solve the problem. And, there were articles in Bloomberg and other news sources that said the ship was going to be up there. And so I started tracking it, and about midday that first day, it abruptly makes a left turn and heads into Savannah. And then it drops about a third of its cargo in Savannah, moves up the coast to Charleston, drops another third, and then finishes up at Wilmington. And we can see that as soon as the October outage occurred, October 31st, here we go with the same ship moving out of its comfortable Gulf Coast shuttle duty and heading straight up to Perth Amboy to help out on the New York side. The Rio Bouchard did the same type of thing. Rio Bouchard is normally a ship, an ATB actually, articulated tug barge that moves into from the New Jersey coast area, carrying refined products up into New England, and suddenly it's making a trip down to Chesapeake, Virginia. And you can see these other ones too. So you had a bunch of ships moving products into non-normal areas in order to help cover these outages. And so this is what it looked like on Vessel Tracker. And you can see this is the Ohio. You can see the abrupt left turn. If you look at where Jacksonville is listed, move out to the right just a little bit, you'll see the abrupt left turn where the ship goes into Savannah. You can also see in the Gulf where the ship is normally making the kind of milk runs into Tampa Bay. And we have a couple more to show like this. We have the Rio Bouchard, normally spending all of its time in Long Island Sound up to Boston. But then we have a sudden detour that goes down into Chesapeake area and also up into Baltimore. Here's the ATB Innovation. Had the same kinds of movements, normally moving in between Gulf Coast and Tampa, but suddenly it was doing a lot of movements into Charleston and Wilmington. And the tanker OSG Independence, once again, this one was mostly moving between Marathon's Garyville refinery and Tampa, and then suddenly it's making trips up into Jacksonville and Savannah and Wilmington. So how much gasoline was diverted to meet the outages? Well, on the various ships, we're making estimates here, and we don't know exactly what was on the ships, but we can be pretty sure that it was gasoline because we had a gasoline outage. Savannah received roughly 122,000 barrels, Charleston 202,000, Wilmington roughly 338,000, Jacksonville picked up an additional 80,000 from normal, and Chesapeake picked up 85,000, and that gives you a little over 800,000 barrels. For the October outage, we had 549,000 barrels head up into Perth Amboy that would normally not have been part of the equation. And then Carteret picked up an additional 183,000 barrels. And that gave you a total of just over 700,000 barrels. So what we had was the waterborne activities, waterborne movements were giving the shippers much more flexibility to deal with the problem. But here we go. And so now that we're going to move into the diesel section, I'm going to hand it back to Suzanne.
Thanks, Jeff. And just a reminder, if you have a question, go ahead and type it in that text box on your presentation manager screen and send it over, and we'll address those shortly. So Looking first at what's ahead for diesel, I'm going to take a look back at what happened this harvest season with diesel. And this is our Genscape supply side data. This is aggregated into monthly data and then looking at the average barrels per day for number 2 diesel. And after a very strong spring planting season in 2016, it looks like that diesel demand in the fall of 2016 around harvest season fell short of last year. And in talking with folks about it, the explanations I've heard is that, unlike 2015, you've had a year in 2016 where the flat price of diesel has been relatively low. So a lot of the reason we saw that spike in June May, June of 2016 relative to 2015 was all about farmers and other consumers around agriculture for diesel going ahead and just building their stocks and taking advantage of low flat price. So heading into October of 2016, you have your typical consumers with plentiful stocks, and there wasn't a need to supply as much diesel in normal fashion like there was in 2015. And this is a look from a pad perspective of what happened. So 2015 was actually, September was actually relatively strong in both PADS 1 and PAD 2 relative to 2015. We were 5.8% growth in September 16 year on year and 3.7% growth in PAD 2 year on year for September. But October, which is typically that big month, we see that harvest demand coming for diesel. That's where we saw the shortfalls. And again, it's not so much a measure of what was going on in terms of actual harvesting of crops, but more a measure of the fact that supplies of diesel, at least at that level, at the consumer level, were more ample than what we saw in 2015, thanks to a low flat price environment for the majority of the year. So in October of 2016, there was a decline year-on-year of 3.4% in PAD 1 and a decline of 2.8% for PAD 2 year-on-year in October. So that's a review of how the harvest season looked with our supply side data. I'm going to hand it over to Dylan and then take a look at what's going on with diesel in terms of our New York Harbor storage numbers. Dylan?
All right, thanks again, Suzanne. Jumping back to this slide real quick, just to show that of the 65 million barrels of storage capacity in New York Harbor, about 1/3 of that is going to be heating oil and diesel, and I'm going to be referring to those collectively as distillates. Okay, so we were talking earlier about how gasoline inventories typically follow a seasonal trend of decreasing in the summer with higher demand and increasing in the winter. Distillates are going to have a similar seasonal trend, but it's going to be completely reversed in that heating oil has high demand in the winter because people in New York City and the surrounding areas use heating oil to heat their homes. So distillates are going to have their highest demand season in the winter, and because of that reason, we're going to see stocks drop off through the winter and build back through the summer. So to go along with that, you can see that going into the winter, so right around this time of year, you typically see one pretty drastic drop-off of inventories in New York Harbor. So for the past 3 years, this has been the same week that temperatures in New York City have fallen below 40 degrees Fahrenheit. So as soon as they get that first cold front, everyone's going to want to fill their heating oil tanks and be prepared for the winter. And those barrels are pulled out of storage, so we see that drop off. And then typically stocks either continue declining at a slower rate or level out after that. So in 2015, which is the black line on this chart, you can see that through the summer and fall, stocks were building as we would expect them to, maybe at an exaggerated rate. And then in October, we did see that drop-off that we expect to see with the first cold front. But after that, stocks kind of rebounded and leveled out, and by the time the beginning of 2016 came around, stocks were actually building a little bit. So this is pretty atypical and seems confusing based on the seasonal trend, but it makes a little more sense when we look at some of the market conditions that led to the deviation from the trend. So this is distillate stocks again, and on top of it is the NYMEX ultra-low sulfur diesel 2-month contract spread. So this is a good indicator of kind of the structure of the market, whether it's in contango or backwardation structure. So anytime the green area is above 0, that's going to represent these contract spreads are in backwardation. So that's going to be more likely or more common in the winter when prices are higher now than they will be in 2 months. And at that point, many storage owners are going to sell. So that's why we see decreased inventories in the winter. So the inverse of that is contango. Anytime the green area here is in the negatives, and that's going to be more common in the summer, and that's why we're going to see inventory builds when it's more economical to store now and sell later when prices are higher. So this chart only goes back to November 2013 when we began monitoring stocks, but that trend is going to persist backwards for a couple more years if we extend it out. So what's interesting is if you look in 2015 when we saw those big builds, in March we did see the contract spread switch to contango, and we saw subsequent builds with that switch. But when winter came around, the spread never switched back to backwardation as it typically does. And this is mostly a function of low prices. On top of low prices, it was a relatively mild winter. It wasn't as cold as most, so there wasn't as much demand for heating oil as it typically is. So where does this leave us? Ever since then, since March 2015, that contract spread has been in a contango structure, and stocks have been pretty high to go along with that. On October 7th, I believe, just a few weeks ago, we saw the highest inventory level for New York Harbor distillates that we've seen since we began monitoring. Since then, stocks have dropped off with us entering the winter season. So that kind of leaves us, jump back one slide real quick, pretty much exactly where we were a year ago. If you look at the most recent data point for New York Harbor distillate stocks, it's right on top of the level from 1 year ago today. Also, the ULSD front month prices are within 5 cents per gallon or so as a year ago. That 2 month spread has narrowed a little bit, but is also pretty close to a year ago. And refinery margins are still low, where they were between $11 and $13 if you're looking at the 3-2-1 crack spread. So all this to say, we're in the same place we were about a year ago. Is that a good thing? Not necessarily. We were in a pretty strong contango, and stocks were pretty high a year ago. So there are kind of two possibilities that can happen here. We can continue decreasing in terms of distillate stocks and hopefully work our way down to partially normal levels in terms of what we've seen historically. Or we might have a repeat of last winter where the contract spreads stay in the contango structure and stocks stay high. The determining factors here are going to be price, the spreads that are associated with it, and the demand for heating oil going into winter. We'll see how the winter turns out, if it's as mild as last winter was or not. So either way, we'll be keeping a close eye on inventories to see if this typical downward trend throughout the winter is enough to help alleviate the product glut that has been pretty persistent in the New York Harbor distillate inventories for a year or two now. All right, so that's all from me. I'm going to pass it along to Jeff.
All right, folks. Jeff Kerr again, and so we're looking now at the waterborne reaction to high inventories. And guess what? Traders see the high inventories and think, well, it's probably not a real good idea to move the ULSD and fuel oil and other things over to the harbor. So we're not seeing the massive influx like we saw a year ago, and that would probably make sense. You know, it's actually been much more of a gasoline season late in the year than people are used to seeing, and so we're going to see much more of it happening. Looks like gasoline is the dish du jour, and we're having much less distillate for the time being, and that looks like it could be a trend going on for a while. At least for the time being, we haven't really had a lot of cold weather in the Northeast. I live in the Northeast, and it's been relatively mild, so we'll have to see what happens there. Now, if you go down to pad 3, This is the diesel import picture. Looking back over the last 5 years, you can see that up through August, that's the latest area that latest month that the EIA has monthly data on. They've been PADD 3 diesel exports have been up near the top of the 5-year range, and there's no reason to expect that to change. Refineries are running pretty much at full bore. The crude keeps coming in. We need the gasoline everywhere. Gasoline consumption seems to be on the rise. And at least here in the U.S., the diesel is pretty much a byproduct of the refining system. So as long as there's a market for diesel exports and heating oil and the other stuff that comes with it, people will be moving it out. The major markets for diesel exports out of PADD 3 include most of the Latin American countries, Mexico, Venezuela, Brazil, and moves into the transatlantic space. You'll see some going into the Mediterranean and some into Africa. So then it starts really competing with the world market out there. But the PADD 3 refiners are pretty much world class and can compete with just about anybody. So I would expect this trend to continue. And with that, I think it's time to open up the floor to the Q&A, and I'll hand back to my colleague Dylan.
All right, thanks, Jeff. Okay, so we just have a couple questions here, so we should be able to power through them. The first one is, do you monitor the switch of gasoline to distillates in New York Harbor when it happens? So that one is for me. In terms of New York Harbor storage, short answer is yes, we do. So our research involves several things, including regulatory documents, high-def photography of the fields, and even fire safety protocols. So we implement several sources of data when researching the product in each tank, and we are able to pick up on if terminal operators are switching products within their tanks and within their terminals. Okay, we got another one. Looks like it's probably for Jeff. Have we seen more crude Jones Act ships moving into refined product service as the glut moves back and forth between upstream and down?
Okay, yeah, Jeff here. That's something we've been kind of monitoring over the last few months as you have more pipeline capacity getting built, and people are being able to move more of the shale crude directly into the refineries and not needing as many of the ships that were used over the last couple of years to move crude from Corpus Christi into Houston or into the refining centers in Louisiana. And so as the needs of the market have changed, many of these ships that were being used in the crude system are now being switched back over to refined products like they were in the first place, especially on the articulated tug barge side. And so, yes, we're seeing a lot more refined product ship traffic, whereas it used to be crude ships. So, yes, that is a trend that's going on. As I put out a new internal ship movements monthly, and we usually see 2 to 3 ships, articulated tug barges, and sometimes tankers moving from one list to the other. So, yeah, that is a trend that's going on and has been going on probably for the last 6 or 7 months. Next question.
All right, thanks, Jeff. So that's actually all we have. We've got one more specific one that I will follow up with individually. But besides that, if we don't have any more, then I think we're okay to close out a few minutes early here. I'm not seeing any more questions.
Thanks everyone for attending.
Okay.
Yeah, thanks everyone for attending, and hope you have a great rest of your day. Thank you.